Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to take a closer look at WeWork's initial public offering, which is often called one of the worst IPOs in history. We'll explore what happened behind the scenes, why it struggled, and what lessons can be learned from its challenges. This will help us understand both the risks and complexities involved when a company goes public, especially one with a high profile like WeWork. Let's dive into the details and see how the story unfolded. In 2019, WeWork was more than just a company. It represented a new way of working, attracting massive attention and investment. It was valued at $47 billion privately and backed by some of the most ambitious investors. The founder was seen as a visionary who was set to transform the global office market for years to come. However, when WeWork attempted to go public, the results were disastrous. The IPO collapsed, resulting in one of the biggest failures in recent business history, wiping out tens of billions of dollars in value almost instantly. This dramatic rise and fall highlights the risks and volatility in the startup and investment world, especially when hype outpaces fundamentals. The images you see, from rising dollar bills to the WeWork offices and a group of people collaborating, visually represent the financial expectations, the physical spaces that define the brand, and the communities built around the idea of modern work. What was expected to be a successful public debut instead became a clear example of what happens when unchecked ambition clashes with poor management, unrealistic plans for growth, and an almost blind faith in endless expansion. Business experts now question if WeWork's initial public offering was one of the most problematic in history. This presentation will look closely at WeWork's original goals, the decisions they made, where those plans went wrong, and how the entire situation played out in full public view, including the dramatic collapse of its stock price and eventual bankruptcy. WeWork's goals before its 2019 IPO were very ambitious and focused on rapid growth and shaping how people viewed the company. By then, it had already expanded to over 425 locations across 100 cities in 27 countries, showing its intent to lead the global co-working market quickly. At the same time, Adam Neumann worked hard to position WeWork not just as a traditional real estate business, but as a tech company centered on community and innovation. This approach aimed to support much higher company valuations than what you'd expect from a regular office leasing company, highlighting the company's focus on technology and its future potential rather than just physical spaces. Management's plan focused on tapping into a massive global market for flexible workspaces, which they valued at nearly $3 trillion, suggesting abundant potential for growth. They believe that if WeWork could rapidly scale both occupancy rates and geographic presence, they could eventually turn the business profitable through economies of scale. However, these lofty goals depended on assumptions that ultimately would cause serious problems for the company. The idea was to dominate the market by expanding quickly and widely, but the risks embedded in this strategy would later reveal themselves as fundamental flaws. WeWork's strategy focused heavily on aggressive leasing and rapid expansion. They signed long-term leases for commercial spaces around the world, sometimes committing to contracts that lasted decades. But instead of matching those with long-term client commitments, they rented out space to customers on a month-to-month basis. This approach created a mismatch. Fixed costs stayed the same, no matter what, while revenue could change dramatically if occupancy dropped. This exposed the company to significant risk when demand fluctuated. At the same time, WeWork's growth was heavily fueled by venture capital, with Softbank investing over $17 billion through multiple funding rounds. This backing encouraged rapid scaling and pushed the company to diversify beyond co-working spaces, branching out into new ventures like WeLive, a residential community, and WeGrow, a private school initiative. These moves aimed at expanding WeWork's reach, but also added layers of complexity to its business model. WeWork positioned itself not just as a real estate company, but as a lifestyle brand focused on community, wellness, and a sense of belonging, which was a compelling marketing story that drew a lot of attention. However, this focus on lifestyle helped mask the company's financial vulnerabilities. On top of that, the company's governance was heavily centered around its founder, Adam Neumann. He had significant control through 20 times voting rights and engaged in several self-dealing practices, such as leasing properties he owned back to WeWork. This combination of branding and founder control created a lot of hype and drove high valuations, creating a media spotlight. But once public investors got a closer look at the actual financials, the situation became clear and raised many concerns. WeWork's financial losses were a major red flag. When they filed for their IPO in 2019, the numbers showed a $1.9 billion loss just in 2018, with losses continuing at a multi-billion-dollar scale each year afterward through 2022. This unsustainable burn rate shocked investors and quickly undermined confidence in the company's prospects. On top of that, governance scandals further damaged trust. Adam Neumann, the founder, held extreme voting power, allowing him to control decisions disproportionately. There were also several self-dealing arrangements, such as real estate deals where WeWork paid Neumann directly, including paying for naming rights to the company itself. These conflicts of interest and lack of transparency raised serious questions about the integrity of management, making investors wary and contributing heavily to the collapse of the IPO. The idea that WeWork had an asset-light business model turned out to be false. In reality, they carried large long-term lease commitments and significant capital expenses, while their income came from short-term, unpredictable sources. This mismatch meant that as they expanded rapidly, their losses only grew. Additionally, WeWork was valued like a tech company, even though it was fundamentally a real estate business. This disconnect made their high valuation unsustainable. When investors looked closely at the financial details, confidence dropped sharply, and the company's valuation fell by about 70% in just a few weeks. This combination of a flawed model and overvaluation was a key reason behind the collapse of their IPO. Within just a month after filing the S1, the confidence in WeWork's leadership and business model eroded so quickly that Adam Neumann was forced out as CEO. This sudden leadership implosion shook investors and stakeholders alike, leading to the abrupt cancellation of the IPO. In an attempt to stabilize the company and prevent a total collapse, Softbank stepped in with an emergency bailout, highlighting how quickly faith in the company's future had crumbled. This rapid unraveling underscores how critical strong, trusted leadership is, especially during major financial events like public offerings. After the failed IPO attempt in 2019, WeWork managed to go public in 2021 by merging with BowX Acquisition Corp, a SPAC. On its first trading day on the NYSE, shares closed at $11.78, which was a significant drop from earlier lofty expectations, but still valued the company at around $9 billion, giving WeWork a fresh start. However, the company's stock didn't hold up well over time. From 2021 through 2024, we saw one of the steepest declines in recent market history. By late 2023, the share price had fallen to just 11 cents, and the market valuation dropped to below $200 million, down 98% from its debut. This decline eventually led to WeWork being delisted from the NYSE and moving to over-the-counter trading by early 2024. This collapse clearly reflects the ongoing challenges the company faced, despite the earlier attempt to stabilize through going public again. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection in the US and Canada, marking a significant turning point for the company. By mid-2024, the company had managed to shed $4 billion in debt and exited or renegotiated hundreds of leases to reduce its financial burden. This restructuring also resulted in a major shift in ownership, with Yardi Systems becoming the majority owner while Softbank significantly reduced its stake. As a result, WeWork now operates on a much smaller scale, focusing on a model that combines real estate with hospitality, moving away from its earlier lifestyle branding and expansive footprint. This shift reflects the company's effort to stabilize and adapt after years of financial challenges and leadership upheaval. WeWork's journey from a $47 billion valuation to bankruptcy in less than 4 years is unprecedented. The withdrawal of their IPO grabbed global headlines and their stock lost almost 99% of its value once public. Their collapse revealed serious flaws in governance and strategy, making this more than just a business failure. It symbolizes an era where venture capital funded highly ambitious, charismatic leaders who relied more on storytelling than solid financials. The key lesson here is clear. No matter how strong the brand or how compelling the vision, without sound economics and strong governance, a company cannot succeed in the long run. This legacy serves as a powerful warning for investors, founders, and the wider business community alike. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.